Now we're going to look at the journal entries for notes and interest accumulation. So on December 4th, we have principal and interest of a note due on its maturity date. We have a $600 60-day note receivable with a 15% interest. So we receive cash of $615. 600 is for the note and 15 is for the interest revenue related to that note. If that note was dishonored, they would still have to pay the entire amount, in which case we would record that to an account receivable, noting that they owed us $615 or the note plus the interest accumulation. If we have an end of period, so it's the end of the month or the end of the year, and we have outstanding notes, we need to record the accumulation of interest in an adjusting entry. So here we have on December 16th, we've accepted a $30,000 60-day 12% note from a customer in granting an extension on a past due account. At the end of the accounting period, we need to accrue interest on that note. So we have the $3,000 note at 12%, and there are 15 days between December 16th and December 31st, which means that as of December 31st, we accrue $15 worth of interest. We would have an interest receivable and interest revenue. Then on February 14th, when that bill is paid, we would receive cash, additional interest revenue. We would remove that interest receivable that we recorded on December 31st, and we have our notes receivable of $3,000. We can convert receivables to cash before they are due. So this slide talks about how companies can leverage their receivables into cash. So instead of waiting for customers to pay us, if we need cash fast, we can do one of two things. One is by selling our receivables. We can sell our receivables, this is called factoring. We sell our receivables to a collection agency for cash. That collection agency then is going to receive, they are responsible for collecting on our receivables now. We have the cash, we clear our receivables, and we give them over to the collection company to be collected. And then that's how the collection company makes their money back from buying our receivables. The other one is pledging receivables to a bank. So we go to a bank and we say, we need $35,000 cash. We need a loan, a notes payable. We're going to take out a loan for $35,000. And we are going to secure that loan with our receivables. In that case, instead of our customers paying us, they pay the bank. And so they pay off our note as they're paying their receivables. So that's two different ways that a company can turn their receivables into cash quickly instead of waiting for their customers to pay them individually. The last thing that we look at is an accounts receivable turnover. So this shows us how quickly our customers are paying us back for the amount that they purchased on credit. So the accounts receivable turnover ratio is net sales divided by average accounts receivable. So we have examples for Visa and MasterCard here. What we want to look for is if we are speeding up our cash collections or we're seeing a slowing rate in cash collections. What we don't want to see is that there's an increasing number of days before our customers are paying us back. If our customers are paying us back slower and slower and slower, this means that we're going to eventually have cash flow problems because we're not receiving cash from our customers in a timely manner, the ones that are purchasing on credit. So we want to find ways to reduce our accounts receivable turnover. This is where credit terms can become useful. So then we can say, oh, we'll give you a break if you pay within 10 days versus the normal 30 days. That is the end of chapter 7.